Yeah.
Should we feel comforted by those words from Michelle Bullock?
Well, look, we should always feel comfortable about, risk-averse policymakers from financial regulators, and, we're remarkably fortunate in this country to have robust and resilient housing markets, capital city markets, and perhaps we shouldn't rest on our laurels. The future's always uncertain, but I think we're moving into a more certain future in terms of interest rate policy, obviously, and it's interest rate policy that's the main driver of those risks to investors, particularly in those that have interest-only loans, because of course higher interest rates would mean typically lower prices, and those that don't have the equity in their investment properties are exposed, and you may see an exacerbation of a shakeout in sales, which would only push prices downwards. That is highly unlikely to occur, particularly given that the energy in the macro market is certainly for interest rates to remain low for longer, and there's really no prospect of higher rates, but the Reserve Bank are being prudent, and of course I guess it's a little bit of some megaphone commentary happening in the marketplace as well, just to keep the horses at bay and those animal spirits just a little bit under control with those investors. But we are starting to see lower numbers of investors now, particularly in that Sydney market, which was investor gung-ho for a long time, and I think that's a good point. The only problem I have with fewer investors is that means there's fewer rental properties, and we do have a problem with tight rental markets in most capital city markets now, and I think that with higher rents that constrains the budget, and we do have a problem with spending at the moment, consumer spending at the moment, and I think that's an issue.
That's what Michelle Bullock was saying today. She was saying we are carrying relatively high levels of debt that could lead to financial difficulty in a downturn, even though the overall level of stress is currently quite low. Let's take a listen to what she had to say today.
Historically high levels of mortgage debt in Australia raises questions about the resilience of household balance sheets to a change in circumstances and the ability of the financial system to absorb a widespread increase in household financial stress. The information we have and which I've presented today, I hope shows that while there's some pockets of financial stress, the overall level of stress among mortgaged households remains relatively low.
All right, we'll move on now to talking about the auction results over the weekend. How are clearance rates around the country?
Up again, market's looking quite robust. Sydney's, I guess, surprising on the upside. Clearance rate just under 70%, higher than the previous weekend. Another 70% result for Melbourne. Brisbane down a little bit, but Brisbane typically rotates between plus or minus 50%, so nothing much to read into that. It's a smaller auction market, of course. Adelaide was down a bit, and Canberra was down a bit also, but they are smaller markets, and they can tend to be volatile from weekend to weekend. But sellers will be pretty happy with the way the Melbourne and Sydney markets are going at the moment, but the tests do remain ahead of us.
They do. We're very, very early on into 2018's auction season, so to speak, aren't we? So what about the auction listings for
Well, I think we could sort of characterise it, and you're right, we're in the early days, but I think we're coming next weekend to the end of the beginning, and we're going to have high numbers next weekend, maybe 900 auctions in Sydney and over 1,000 in Melbourne. So it is the first big test for the market this year. Higher proportions of inner suburban properties will, I think, push up clearance rates, particularly in Sydney, where that's been a strong sector of the market. So it will be the first big test for the big markets next weekend with higher numbers of listings, and I think we'll be able to sit back and look at that February result, perhaps we'll do that next week, and be able to give our scorecard, our report card for the first part of the auction season this year. But so far, I think sellers are winning the battle.
Okay, just drilling a little deeper into the clearance rates from the weekend. If we look at Sydney's regions,
yes.
What can we derive from that?
Well, look, we had a couple of regions that were just under or at 80 or just under 80%, the inner west, the northern beaches, which have been strong for a couple of years. Canterbury Bankstown props surprised on the upside with an 80% clearance rate, but small numbers of listings. Southeast Sydney region's been a little bit soft this year so far, perhaps need to keep an eye on that. But there's just a sense of a bit more evenness about the results in Sydney, but no doubt the northern beaches and the inner west keep on keeping on, and we should see more listings coming through for that market, which will be good news for buyers that are obviously competing pretty strongly in those areas.
Yeah, and having a look at the same figures in Melbourne now, the the auction results by region for Melbourne.
Well, it's almost getting a little boring there. The northern suburbs every weekend, strong results. It was interesting that there wasn't a clearance rate above 75% in Melbourne at the weekend. Everything was under 75%. North, again, the strongest. The inner city, perhaps a little bit of a surprise result there, one of the leaders. But again, with Melbourne, it's the remarkable, I guess, compaction between high and low. There's not a lot of difference between the range of results in Melbourne. So it shows that most areas are finding buyers. But look, clearance rates in both Sydney and Melbourne are well below where they were a year ago. Of course, it was boom time in Sydney, and it was a very strong market in Melbourne as well. Listing numbers are well down in Sydney. That'll change this weekend, as we discussed, and Melbourne's tracking around about the same. So the market is unfolding, Sophie, gradually. The regions that did well last year are still doing well this year, but these things sort of evolve slowly. But it's a much more compressed market, I believe, between highs and lows.
And moving on to state investor loans now. They're up in Victoria, not so much everywhere else.
Well, look, we're talking about risk management. Those macroprudential policies were introduced a couple of years ago. Of course, we saw the APRA and the banks back in the marketplace again last year. Interest rates for investors increased from around about mid-year. And interesting enough, if we look at the volume of lending, or the change in lending from the last half of last year compared to the same period the previous year, I guess we wouldn't be surprised to see that volumes were down, but they weren't down everywhere. In fact, Victoria actually recorded, despite those higher loans for investors, higher rates of interest for investors, Victoria investor activity actually increased, which just shows you it's a bit of a blunt weapon, this overall higher rates for investors in terms of risk management, and it does affect markets differentially. And I'm not sure the Queensland market, which did suffer the most in terms of reduced investor activity over the last 6 months of last year, would be terribly happy about that, particularly that inner city Brisbane apartment market, which, as we know, has a lot of stock in it at the moment. So making it tougher for investors in that market just shows you how it can be an unbalanced mechanism when it's a one-size-fits-all policy. But Victorian investors are certainly still attracted to that market, that Melbourne market, despite higher interest rates.
We've also got some figures to look at the investor lending versus owner-occupied rates.
Yeah, I think that's a very interesting graphic, because it shows us that as I said, the change in investor lending actually rose from around March last year, and we can see that there rose quite strongly. But the lending for owner-occupiers actually fell during the year. So banks were obviously saying, well, look, we're losing market share perhaps, or volumes to investors, but we still want to keep it ticking over for owner-occupiers, so our overall lending remains quite balanced. So it was a lot different to what happened in 2015. But what we've seen with falling rates for owner-occupiers and rising rates for investors is a record difference between the both. It's now 0.6% difference between the typical investor loan and the typical owner-occupier loan. So it's very much a skewed market in that sense. And, got to be a little careful that that doesn't create, I guess, opportunities for people to be looking to change their investor lending into a sort of an owner-occupier model, and vice versa, or perhaps looking for secondary lenders. But we can see now that there's a different market set from banks and our regulators for owner-occupiers versus investors.
Yeah, well, it'll be interesting to get the wrap on that next week, when we can look at the whole of February and maybe compare it with last year as well.
Good on you, Sophie.
Thanks, Andrew.
Thank you.